How do we value an investment, maybe a business, or perhaps even a real estate? How do we come up with a price that we are willing to pay for that investment? Now, this is a very broad topic. There are a lot of formulas, a lot of theories, but I'm going to share 5 things that I look at to get me started. Now, when I'm looking at an investment that I'm about to make, I want to understand how much money historically this business has made and how much money this business can potentially make in future. So there is an established part of an investment and there is a speculative part of investment. So let me try to make break it down and make it a little bit easier. Let's say you want to buy a property in a very nice neighborhood. Maybe you can put that on Airbnb because there's a lot of tourists out there. Now, seller comes to you and says, look, I want $1 million for this property because Disneyland is going to open up a park not too far away from this property. Now, you as a buyer have a dilemma. So you say, look, this property is worth $500,000. Okay. And yes, business will double or triple if the Disneyland park actually comes here. Possibility. But from a seller's point of view, he thinks that have already happened, and that's where all kind of problems comes into play. So I'm going to break this whole psychology down, and I'll share some of the numbers that you might be able to use to negotiate with a potential buyer or seller, or if you're trying to buy an equity, maybe you can use those numbers to kind of take a look and see if that equity makes sense for you. Or if you're trying to sell a property, maybe that will help you come up with a very reasonable price that you can use to put up on market. So like I said, any business has 2 parts: an established cash flow that business is already generating, and a cash flow it can potentially generate in future. So we're going to break it down into 2 parts. I think the first part is fairly easy. Like, let's say if I ask you to evaluate McDonald's, I think it would be fairly easy because McDonald's kind of does the same business year after year. McDonald's have a very good brand reputation. McDonald's had a good history. You can take a look at their dividends. You can take a look at their revenue. You can take a look at their growth, their margins, how much cash they're producing. So you can take a look at all of that stuff and easily evaluate. But if I ask you to evaluate a company that is perhaps a startup, that will become really, really hard because all the numbers is going to look negative. So a lot of valuation that happens in market is based on future possibility. So, and there are formulas for that as well, by the way. If those are the companies that you like to buy, then there are different kind of valuation methods that you can use to value those companies. But today I'm going to focus more on established businesses. There are plenty of established businesses in my opinion, and to be able to gamble on businesses that I don't know, why would I do that when I have an alternative available? But that's just me. There are a lot of high risk takers, and they're willing to go a different route, and that's okay if that's what you are. But today's video is all about established businesses. So maybe you're buying a property that already have a long-term rental or a short-term rental. Maybe you're buying a business like an established business, or an equity in a company that is a very well established company. Those are the kind of businesses I'm talking about in today's video. All right. So I start out with a present cash flow. How much money this company has made in last 12 months. That means this is the cash after paying off all their expenses, all their bills they have left over. Why? Because what is company going to do with that cash? They'll do one of the 2 things. One, they will pay it back to me as a dividend, so I make money. Or 2, they will use that money to expand their existing business. And if their business expands, once again, the business makes more money, then I get more money. Or they can possibly also do acquisition of another company that can also bring growth to the company, and then eventually I make money. So I want to see how much cash this business has made in the last 12 months. Okay. Now remember, I'm not talking about revenue. I'm talking about after paying everybody, what are they left with? Next thing I want to take a look at is how did they do last year? How did they do, you know, last 3 years, last 5 years, last 10 years? I take a look at all those numbers and I kind of try to figure out how much growth is this company having in their cash flow. You know, sometimes that growth might not be there because the company is investing back into the business. I want to know that, and we'll that's a point number two. We'll talk about that just in a second. But normally, what happens is a well-established company will try to always increase its cash flow in spite of making expenses into growing the existing business. So if I can find a company that is growing an existing business and increasing their cash flow, that's a win-win situation for me. So that's the first thing I look at. Okay. Second thing I try to figure out is, can this company add a new revenue source? Can they bring on some other way to make money? So for example, let's take an example of Meta, right? Facebook. They have tons of customers in the United States, different countries. If they can come up with a product that makes them, let's say, $5, $10 per user, that can have a huge impact on their balance sheets. So I like those kind of businesses. You know, they can add on new products, new services, and they can make tons of money. So I definitely want to pay attention to that. Let's say if it's a small business, let's say it's a gas station. Now, does this gas station already have a convenience store? You know, many of them do. But does it have a car wash? Can I add that service? Can I add, you know, something else? You know, maybe a food truck? You know, what else can I add to that business that can make me more cash? Let's take an example of investment real estate. Maybe you bought yourself a nice short-term rental somewhere, and that short-term rental has 3 bedrooms. Well, what else can you do with that bedroom? Can you add an extra bedroom? Can you add an ADU to that unit? Can you do something with your backyard, with your front yard? You know, what else can you do with that property that can generate extra cash? That's extremely important for me to come up with a valuation for that property. Let's just say, you know, property is in 5 acres and there's only a small house on there. You know, can I set up tents in that property? I need to look at the possibility, like what else can be done with it. I might do it, I might not do it, but at least that gives me some idea as to how I can grow that business. Okay, so that's my number two. So number one, how much money they have been making. Number two, how much money they can possibly make by engaging in new ventures. Number three thing I look at is, what are they doing to improve their efficiency? You know, for most businesses, when they're starting out, they're not that efficient. They're still learning. They're still finding new vendors. They're still finding new contracts. They're still finding a better way to do construction. They're still learning how to reduce their cost. But as that company matures, the cost of doing business usually comes down. Cost of marketing usually comes down. So I want to pay attention to these kind of businesses who are at that transitioning point, because if that cost can come out, they can make more money. Obviously, like I said, more money means that they can pay me back as a dividend or they can invest that money back into the business. Let's take a look at it from a small business point of view. If you are buying a gas station, what can you do to bring more efficiency? Can you automate some of the things in the business? Can you maybe add, technology such as solar that can reduce your expenses? You know, can you add an automated car wash? What can you do in that small business to make you more efficient? I think many businesses can become efficient if they just pay attention to that. So if you're a small business owner, if you just pay attention to this, you can actually generate great ROI just by doing little things. One of the easiest way to become more efficient is by paying attention to your taxes. So obviously, as you guys know, our primary business is taxes. We don't give investment advice. We don't tell you what to buy, when to buy. You know, I share my ideas, some basic principles as to how I look at the market, how I look at the world. But trust me or not, taxes is one thing that impacts everyone. We see people who are paying minimum tax, and we see people who are paying like enormous amount of tax, and they've been paying that tax for many, many years before they come to us. So by engaging with a good tax firm, you can come up with a great tax plan that can help you become more efficient as well. Okay. Having a good understanding of financials can also make you quite efficient. For example, managing your cash flow, having a good budget, good debt management, good insurance agents on your team, good finance people on your team who can refinance the debt for you, who are always looking out for you to reduce your cost. Those are some of the great ways to become efficient. Now, that's just from a small business or uh, even a real investment property point of view, right? You can add solar on that property. You can add some better windows. You can have better appliances. There's so many ways to become efficient at all levels. I think all of us can benefit this with this one simple strategy. But a big business, can you imagine a $10 billion or $100 billion business? If they become efficient by 10%, what can that do to their bottom line? So I'll give an example. So right now, I'm recording this video in April 2024, and ChatGPT, Microsoft, artificial intelligence, NVIDIA, these are some of the stories that everybody's talking about, right? And the idea is that these companies are going to launch products that are going to make everybody more efficient. Now, what does that efficiency mean to an average user like me? So let's just say, let's take Microsoft as an example. What does Microsoft do? They sell Windows on every operating system. I don't know how much efficient that can become, but they have Word, they have Excel, they have PowerPoint, they have Outlook. I think that's the one product that everybody uses. Now, Microsoft also has servers, they have databases, they have all a bunch of other stuff going on there. But just to kind of make my point, let's just focus on this one suite of product, which let's call it Microsoft Office. If I hire somebody to manage an Excel sheets in my business, maybe I pay them $20 an hour, $25 an hour, maybe $30 an hour right now. But if I want to hire a data scientist, that might cost me $80 an hour, $100 an hour. But if Excel becomes so good with this AI that this average person, $25 an hour person, can give me the same result as a $100 hour person, that's a productivity of $75 per hour that I did not have before. Okay. Now, to gain $75 per hour, am I willing to pay Microsoft 20, 30, or even $50 a month extra? Absolutely. That's where that's what efficiency can do for you. If you're a business owner and you can make other businesses efficient or even consumers more efficient, I think there's a value for your service. And as an investor, if I'm looking for, buying a company or buying a business or even buying a property, if I can make that investment more efficient, then that's good for me as well. So that's a third thing I look at is what is this company, this business doing to become more efficient? And how is efficiency going to impact them? Normally, what happens is when they have a management change, a new mindset comes on the table, and they kind of bring that efficiency along with them. Sometimes it backfires. They take steps that are, counterproductive. That efficiency is counter efficiency. That means, all of a sudden they start having all kind of problems. So you want to pay attention to that. It's not as uh, quantitative to begin with. It takes time, right? Like let's say if you put up a solar plan, you're not going to see the results right away. It might take you a year or two to see those results. So I look at cash flows. I take a look at what new ventures, uh, and then I also take a look at efficiency. Next, I would take a look at the growth cycle for that business, growth cycle for that sector. So let me break that down for a second. So every business starts out with a startup model, and then it gets into product market fit, then it gets into growth model, and then at some point it just dies out. Just like everything else in the world, it it is born and then it dies. right? There's no such company as that never dies. Everybody has an expiration date. So you want to look for companies where you can get in early enough that you can take advantage of that growth. And you don't want to get into a company so late that now that company is just going downhill from there. So you want to take a look at that. Sometimes companies could be good, but they could be in a sector that is dying. So you also want to take a look at the sector. You don't want to go against the wind. Now, that doesn't mean that company can't survive. Maybe there is a model, like for example, a lot of cigarettes company, right? Cigarettes are a declining market. People are kind of moving away, but there are companies in the cigarette market who made tons of money. So I'm not saying they can't make money. I'm just saying I would rather have a company that is going with the wind instead of going against the wind. It just makes it easy. Lastly, I'll take a look at the risk involved with the business. And if that risk matches with my risk tolerance, that is so important. So let's say, if I lose 5% of my capital, I can't sleep. It's like it bothers me. I can't focus on anything else. Well, in that case, I would probably focus on, something else that is a little bit more stable. Maybe not these kind of investment. Maybe I'll look at annuities. Maybe I'll look at CDs. Maybe I'll look at some of the very well established businesses that don't have as much volatility. You know, if I can absorb a little bit more risk, then maybe I'll look at S&P 500, total market indexes, maybe dividend ETFs and so forth. If I can take even more risk, then maybe I'll look into some of the equities. If I can take more risk, maybe I'll look into owning a business. So it kind of really depends upon what my risk tolerance is. And then I also want to take a look at what kind of, if this event happens or that event happens. Now, I don't like to get stuck in analysis paralysis. I don't want to make a list of every single risk. I mean, you can find those risks, especially public companies, they list it out for you in their annual statement. They tell you what risk they have. But if you read those, you will never buy anything. So I want to kind of just see, on a broad level, what kind of problems this company can run into. And if I'm okay with that, like if that happens, what would I do next? And if that bothers me, then maybe I won't go there. So those are the 5 basic principles. Like I said, you can use that to when you're trying to buy an equity. You can use those when you're trying to buy a business. You can use these principles when you are trying to buy an investment real estate and so forth. But in no way this is complete. This is just a starting point, and I'm sharing this with you because many times I talk to clients and I ask them, why did you buy that? They had no idea. They bought it because the friend said so, because somebody told them this is a good idea. Maybe they watched a TikTok video or they were impressed with somebody on YouTube and stuff like that. They did not really do any research. They did not really spend their own time figuring out if this was the right way for them. So that's why I thought, maybe I can lay out some basic principle just to get started. I think many problems can be caught if you just look at these 5 things. As a reminder, look at the cash flows. Can't lie, right? You look at the last 10 years cash flow. If they're negative, if the company is just not growing the cash flow, I don't want to go there. Maybe I want to buy a business that is making money instead of losing money. I want to buy a business that can expand, that have new possibilities, new probabilities. I want to take a look at businesses that are exploring new ventures. I like those, right? I want to look at businesses that can become more efficient, that can improve their margins, that can reduce their cost, that can produce more cash. I want to look for businesses that are on a rapid growth cycle. I don't want to invest in businesses and companies that are about to die. And I want to definitely evaluate the risk factor. So anyhow, those are some of my thoughts on how to evaluate a business. And we talk quite a bit about those in my workshops. So you can always go to taxcodeadvisors.com, sign up for my workshops and learn more about those. If you have a question, comment, please leave it in here and then we'll try to answer that on the next video. I'll see you soon.